Hey Mario, how you making out?
I'm doing great, Bob. How about you?
Could be better, couldn't be better. It's beautiful spring weather here in New Jersey, and now that spring has sprung, I think maybe the banks are no longer on the run. I think we're in a pretty good spot right now.
You're a poet,
Yeah,
scholar, and a gentleman.
yeah, temporarily. We'll see. So this brings us to what, the first quarter of 2023 to review what's gone on in the global economy. Certainly had some ups and downs, but thankfully people's emotions got in check, is what I would like to think. And things have started to settle in a little bit again. But hopefully, you're going to go through all the things to be thinking about from the positive and also the headwinds we may be facing. So I'm just going to turn it over to you at this point, Mario.
All right, sounds good. All right, Bob. Well, as you teed up in our intro, we do like to start these calls by highlighting some of the reasons for optimism and some reasons for pessimism or uncertainty. So on the left, we have the positive signals. Importantly, that inflation does continue to fall here in the US. It's good news that we're not currently in a recession, and we'll talk about the signals that tell us that we certainly are not. And then the dollar has come back from recent highs. And while that may not sound great from a consumption standpoint, it is a good thing from an investment standpoint because we have a sizable chunk of our portfolio in non-dollar denominated securities. So that's given our portfolios a little bit of a boost. On the reasons for uncertainty side, we said inflation is falling, but it is still high all around the world. We are seeing some signs that a recession may be in our midst. And then, as you mentioned or alluded to earlier, the banking crisis really was a curveball in our economy. And while the Fed stepped in to shore things up and restore confidence, there are some potential fallouts that are yet to occur. We've heard anecdotally of a tightening of credit. And when businesses and consumers can't borrow or don't borrow, it does slow down economic growth. So we're just going to have to see how that plays out. But what we'd like to do is start our conversation by talking about March Madness. And we are not talking about the NCAA tournament, but we are talking about that craziness in the bank sector. And just to recap what happened, the collapses of Silicon Valley Bank and Signature Bank, and then Credit Suisse's forced sale essentially to UBS caused a lot of bank customers to worry about the safety of their deposits. And as I mentioned earlier, government agencies did act fairly quickly over the weekend to restore confidence and make sure that consumers and bank customers felt like their assets were safe. It's now largely agreed that money is safe up to the FDIC limits. But as I mentioned earlier, it's probably too soon to tell what all that fallout is going to be, especially in regard to lending and banks' profitability. And the next slide indicates that the market has taken notice of banks' profitability or the infringement upon profitability. And without getting into too much detail, what you're looking at here are the worst performing stocks for the month of March for three different stock market indices. And if you just look for the word bank, it does appear quite often in these lists. So it was really there was a broad-based impact on financial stocks, even for banks that really didn't have any concern in terms of the safety of deposits. The crisis also impacted the Federal Reserve's interest rate policy. If you think back prior to the crisis, most Fed watchers expected at least a few more rate increases because inflation was really the number one thing that the Fed had in its sights. But the outlook is a bit hazy now because we've noticed that the Fed's rapid rise in interest rates had put a challenge on banks' balance sheets. They had to invest in securities that are a bit longer in maturity, a bit lower in yield. And with the Fed raising rates at the short end, that has forced or inspired depositors to pull money out of banks and put money elsewhere. And that's where the banks have gotten in a little bit of trouble. So now the Fed has a little bit of an issue on its hands trying to decide what takes priority, their fight against inflation or making sure that banks remain solid. These symbols that you're looking at, we've used these a couple times now, but they represent the Fed's pace of rate changes. The first icon on the left, then the pause, and then the pivot to decreasing rates once they realize that inflation is in check. The pace has certainly slowed. We haven't seen the pause yet, so the pivot seems a bit further out. And right now, we really just see a lot more commentary that the Fed is going to focus on inflation first. We may even get more increases in the near term. The goal that the Fed is trying to achieve is what's called a soft landing, to bring inflation down without high unemployment or causing a recession. This hasn't been easy to do historically, but it's definitely not beyond the realm of possibility, especially with what we're seeing from current economic signals and in particular, the labor market. This page, and sort of jumping around here back and forth, but this page shows the influence that the banking crisis is believed to have had on the Fed's plans. So if you look back on the the March 8th number towards the right of your screen, this is telling us that the market predicted that the Fed's rate would someday get as high as 5.7%. But if you shift to the right, after that banking debacle, that was reduced to 4.9%. So the implication of that is that nothing really changed regarding inflation expectations. It's just the market's inference that the Fed's ammunition might be dangerous to the banks. So we will have to wait and see if that has really hurt the Fed's ability to control inflation. Or the silver lining here is that it may actually give the Fed a moment to wait and see how its policies to date are impacting the economy, because sometimes this happens on a lag. So if they just feel like they need to keep acting and acting and acting, and then all of a sudden the impact is felt, you may find that they have overshot. So we're going to have to wait and see how that played out.
Yeah, I'm going to take a quick second here, Mario, on that slide, because it just supports the fact that the markets react to new information. And there's been a lot of conversation and a few calls that I've taken in regards to the volatility that's taking place in the markets, whether it's, up, down, or side, up or down. And, here you have, again, what are supposedly some of the brightest minds projecting in the market a 5.7%, rate, top rate. And just in a few days, a little bit of information comes out and it drops to 4.6 and lands at 4.9, a few days later after that. It's sporadic. You can't predict what's going to happen tomorrow or the next day. Don't try and do it. And I just keep coming back. Like, now, our clients, when you need money, you have a diversified portfolio. Not everything's tied up in cash or bonds or domestic or foreign stock. It's all over the place. So depending upon what is performing well at that time is where we can pull some cash from. So anyway, or whatever your portfolio looks like. But we have strategies to ensure that your cash flow is met regardless of what's going on in the variations in the portfolio, the pieces that make up your portfolio returns.
Yeah, that's a great point. I mean, you look at the jaggedness of this line, and even though it's not asset price, the use of the term sporadic is a good one when these things occur, and it's also erratic, right? There's no way to know if the next bit of news is going to be positive or negative, and by the time you have an opportunity to react, the market already has. So it's tough. So this slide here shows the rate of inflation going back to 2019. So just before COVID, before we didn't even know the word COVID, you see that inflation is broken down by goods in green and services in blue. And back in 2019, you can see that inflation was 100% from the services category. And at the far right, we're starting to return to that, right? Remember, during COVID, all the shipping challenges and supply chain and all that kind of, everybody talking about, you can't get a dishwasher, you're on back order for 18 months. So that was the goods inflation that we saw due to COVID. So you're starting to see that come down. However, the blue part, the services part, is still very high. So the level of inflation overall is much higher than desired. And in particular, within that services segment, you have the shelter category. So basically, they use a function or a formula that assumes how much rent someone could charge, even if they own their house. And that portion of inflation is still stubbornly high, but economists note that that usually works on a lag, and it is expected to come down. So we should start seeing inflation really coming down, barring any other unforeseen circumstances. Now, I mentioned in the very beginning about the fact that we're not currently in a recession, and in fact, our home economy is actually pretty good. This graph shows you where we stand on key recession indicators. Those indicators are listed at the left, but really all you need to do is think of this as a heat map. And if it's green and yellow, that's generally good. If it's red and orange, that's generally bad. So if you look at the far right, we're definitely not seeing any reds. So that tells us that these broad categories of employment, spending, and manufacturing are still holding up quite well, despite the Fed's aggressive actions last year. So now to start looking at investment returns, we'll dive into the bond market. The set of bars at the left show positive returns for all the bond indices that we track, which is basically short and intermediate term bonds. Intermediate term treasuries and corporates, the yellow and the light blue, led the way with returns over 3%. The bars at the far right show a whole different story. This is the 12-month returns ending March 31st. And basically, those returns are still baking in the poor performance that we saw in 2022. Municipal bonds, as you can see, the gray and green bars were the only bright spot, and actually showing positive returns, which is great. And the other great thing is that they're actually still offering compelling yields compared to taxable bonds. This slide shows a few different yield curves, and yield curves is a fancy way to say the yield of a particular type of bond with various maturities. So short-term maturities at the left, long-term maturities at the right. And this is as of March 31st. The top left one, if you specifically focus on the dark blue line, that tells us that shows us what's called the inverted yield curve, where short-term rates are higher than long-term rates. This is unusual because usually you would expect to be compensated more for locking up your money into a long-term bond. But here, you're actually being rewarded for staying short, and it typically is looked at as a recessionary signal. It's not a cause of recession, but we believe that the market does price in a lot, as you said, all information almost immediately, and the collective wisdom of crowds kind of tells us that if the market is collectively anticipating a recession, it's not a guarantee, but sometimes it can be a self-fulfilling prophecy.
Yeah, I'm looking at the chart on the bottom right for corporate, and I'm going to think the more startup style company is going to require is only going to be offered shorter term debt. So you were talking about early on, this would just lead to stagnation. I know for myself, if I had to borrow money for the company or wanted to expand or do something, and even if it was going to be a short-term type of transaction for a few years, you're now, the cost of money is over double what you would have been paying previously. So it makes you think twice. It's still not high at 5% in my mind. I think that's still a very reasonable rate. It's just that when people were able to borrow at, or large corporations at 2 and 3%, that was 2.5%. That's massive stimulus, and putting money into the economy, and this is just sort of making them check their decision-making process. So
absolutely. I mean, chief financial officers were shaking their heads last year, right? You come in the year with cheap borrowing rates, and like you said, more double or triple by the end of the year. Kind of makes you change your strategic plan a little bit.
Yeah.
So that was a great point for, looking at the bottom right chart from a borrowing perspective. For us as investors, really the main takeaway from this slide is that all the slides on here represent different types of bonds. You talked about the corporates on the bottom right. We have municipal bonds, we have foreign bonds, and the level and shape of each of these yield curve and the fact that they are all different means that in our portfolio, we have opportunities to add value, add incremental return where possible, and also diversification. So we're not just subject to the movements of US Treasuries, for instance.
Yeah.
Now, this slide paints a picture about why we shouldn't be sitting on too much cash, even if cash yields are historically high. If you just look at the bar labeled 18.6, it'll tell you how to read this thing. This tells us that 10-year bonds returned 18.6% on average for the next year if you invested a month before the Fed's last rate hike. I know that's an earful, but basically what this is saying is that there are a lot of people out there that are saying, why should I invest in longer term bonds that are only paying me 3% if I can sit in a money market fund and pay 5%? Well, this is telling you that when the Fed stops raising rates, there is a significant bump in performance, or historically, there's been a significant bump in performance of longer term bonds. So we want to make sure we're balancing our reasons for holding cash versus the opportunities that exist out there in the market. Now, the other thing we want to think about is if that money is earmarked to invest and you're and I know your clients tend to not do this, Bob, especially at your discouragement from sitting on the sidelines. If you have money that you intend to invest, we try to get it invested. We try not to time things. So the other reason for not sitting on too much cash right now, even if it is earmarked to go into a bond portfolio, is that with yields where they are today, bonds are a better insulator against equity declines, against stock market declines. So you want to make sure you have that insurance policy in place.
Yeah.
So similar to the bond graph, this shows you the performance of the various portions of the US stock market. And if you look at the left side, you can see that in the first quarter, there was a pretty wide dispersion between the best and worst performing size and style category. In particular, small cap value was effectively flat and large cap growth was up 14%, that gray bar. For the 12-month period at the right, small cap value's poor first quarter, which was related to the bank crisis, pushed it to the bottom of the list. But sticking on the value side, large cap value has actually held up the best for the 12 months, despite large cap growth's strong first quarter. So similar to the slide about bonds and the Fed policy and things like that, this graph shows returns for the 12 months following the last 6 Fed hiking cycles. When you hear the word hike, we mean increasing interest rates. So the last 6 times that the Fed did this, these graphs show you what the returns were subsequently for the S&P 500. So you can see that they're very positive, right? People might be hesitant to invest when they start hearing words like recession. But if you look at everything taken together, and especially the understanding that the market is pricing in all known or knowable information, historically, you would have been behind the 8 ball by worrying about, what the Fed is doing, what the economy looks like. We're not trying to say time the market or get into the market because of this, but we are trying to say don't let certain things dissuade you from remaining invested and sticking with your investment plan. Historically, you're rewarded by investing through these cycles and trying not to outguess the market.
I love slides like these, Mario. So thank you. It just supports the idea, again, that these headlines and the information that's swirling around, and it just brings out the fact that we have a human trait that we can make really poor decisions around investing due to what's innate in our being as the fight or flight. And so we try and digest all this information and think, okay, well, let's just get to the sidelines. thankfully, our clients have overcome that for the most part, but it's still every now and again it comes to a point where, God, is it, this is tough to handle. Let me just get to the side or something. So thankfully this is good support for what not to do.
Yeah, I like the fight or flight. I'm kind of thinking about, walking down the street, if you see a fight, that's an uneasy feeling. If you see somebody, sprinting away, that's an uneasy feeling. But if you just keep walking forward with a confident gait, you tend to be left alone. You get to your destination and everything works out, and that's the right way to do it.
Yeah, thank you. Yeah, good stuff.
So we've gotten a lot of questions about the value investing versus growth investing and which one will outperform based on changes in interest rates. So this graph really kind of lays it out perfectly. And it shows the value investing's track record in rising rate environments in the green bars and in falling rate environments in the blue bars. So basically, if the arrow or the bar is pointing up, that means that value has outperformed in that year. If the bar is pointing down, value underperformed that year. So you can see that the colors are dispersed pretty well. And, if you consider the fact that value's best year and its worst year, so the far left and the far right were both in falling rate environments, that would kind of, lend a counterpoint to the argument that the direction of interest rates has any bearing on whether value or growth should outperform. Now, that being said, we actually dug into that further and asked our friends at Dimensional about not just when rates change, but what about their overall level? And they put this graph together. And I know it kind of just looks like a bowl of, I don't know, my daughter would say it looks like a bowl of sprinkles. To make sense of it, let's look at the lines. So
I want some ice cream now, Mario.
You're welcome to have, Bob. It's almost lunchtime. You can do whatever you want. So what you want to take away from this slide is the blue dotted line, which is, I know it's kind of faint, but it's that one that is the very top line and it's very flat. And that indicates that value investing's performance is very consistent at any rate level, right? Historically. But growth's historical return, which is that downsloping, I think it's like a greenish gold kind of line, that indicates that growth's returns have been lower when rates were higher, right? So I guess, yeah, so that's really the main takeaway. And we hear that a lot. We hear things like value outperforms when interest rates are higher. And digging into that a little bit further, it's not that value's performance is better, it's that growth performs relatively worse in those environments. So interesting information that they dug up. Yeah. All right. So we're closing out the presentation with just a brief discussion about international stock returns. So what you see here at the far left is the blue bar, which represents large cap stocks. I mentioned this earlier. We're up 8.5%. And if we think back a couple of slides, that's a lot better than its U.S. counterparts. I mentioned very early in the presentation that has to do with the U.S. dollar, and we'll talk about that on the next slide. The small cap stocks outside the U.S. in orange also did better than their U.S. counterparts. So our international diversification did help us out in the first quarter. Over the past 12 months, large stocks outside the U.S. have actually also held up quite well versus other ex-U.S. categories and in regard to our U.S. stock portfolio. So we've been saying for a while now, getting back to sort of the non-U.S. investment story, we've been saying for a while that non-U.S. investments are easily justified by their relative valuations versus the U.S. So a little bit of education here. When you hear the term price to earnings or see that PE ratio, that basically is an indicator of how cheap or expensive a stock is, right? So the lower the price to earnings ratio, the cheaper a price is relative to the earnings that company brings in. So if you look at that inset, the current PE ratio of the S&P 500 is 17.8%. The average, the 20-year average, which is just to its left, is 15.5. So right now, the S&P 500 appears to be overvalued versus its own historical track record. This ACWI XUS right beneath it is essentially the rest of the global stock market. So you can see its PE of 12.6% is not only much lower than that of the S&P 500, indicating that it's cheaper, it's also cheaper versus its own history. So when we talk about international returns doing okay in the recent past, there's still a lot of room to go and a lot of justification to maintain that diversification. At the far right, basically what that's telling you is that there is a higher dividend yield for non-US stocks than US stocks. And that's partially to do with the technology stocks and growth domination here in the US. But regardless, the main takeaway is that even if non-US stocks don't shoot through the roof in the immediate future, you're sort of being paid to wait, right? You're getting your dividends, you're reinvesting and things like that. So here's the slide about the dollar. The main, one of the big drivers of strong international stock returns has been a pullback in the US dollar. So if you look at the far right side of the top graph, you can see that recent decline was kind of precipitous. And as I mentioned earlier, when that happens, yes, it becomes a little more expensive to buy things that are made overseas, but because our non-US investments are not dollar denominated, then that means that the currency they are denominated in appreciated in value. So that's why our investments benefit from a falling dollar. And as usual, that's the end of our prepared remarks. So we leave this slide that allows you to, pick out a topic for successful financial planning. We know that, we don't try to time the markets. Investments are not the end all be all. And most importantly, your success is going to be determined by focusing on what matters and things that you can actually control. So Bob, I'll kick it back to you.
Mario, I always love this slide. This sums up our purpose as wealth managers and financial planners. We want to see, like you said, right at the very end, we want to see our clients focus on the things that they can control. Do what, go enjoy your life. We're here to help get you to your point where you can be financially independent. And then when you become financially independent, replace that paycheck, that human equity that you put in all your life, and go do the things that maybe you love doing your job. So, continue at it, fine. But a lot of people we find had things that they put on the sideline for a long time. And if you can turn off the TV and just, stop getting distracted from the headlines, there's an awesome world out there to be discovered. And we hope to be the ones to help facilitate and make that possible for you. So that's it. So thank you again for another excellent quarter, Mario, of, helping us understand all the moving pieces that we get bombarded with the headlines, and letting us see under the cover a little bit as to, what the impact is to us and our clients and how to just perceive these elements. So thank you again.
Absolutely. Glad to do it.
All right, Mario. Let me stop the share. I don't want to end.